I've used my life insurance to pay for business expenses, bought a car, even invested in real estate. And in this video, I will show you how exactly. My name is Blessed Ikeja Bamoalo, and I've helped countless families and entrepreneurs protect what matters to them and build generational wealth. And today, we're going to be talking about how to take a loan or how to take money out of your life insurance. Most people think of life insurance as something you buy, pay into it until you die, and then it goes to your family. Now, have you heard about the life insurance you use when you're still alive? That's the one we want to talk about today. So when you get a permanent policy, let's say whole life or index universal, when you pay your premiums, premium is the amount you pay every month for that policy. When you pay that premium, a portion of that premium goes into your cash value bucket. That portion grows with compound interest. A smaller portion pays your cost of insurance. Think of this portion that goes into your cash value bucket as a savings that grows. There are two ways you can lay your hands on your cash value inside your life insurance. The number one way is to withdraw the money. Think about this as taking money from your bank account. So when you have 100,000 in your bank account and you go there, you take 50,000, how much do you have left? You're right, 50,000. That's exactly how it is when you withdraw from your life insurance. That portion that you take out reduces from your total cash value. Now be careful when you withdraw from your life insurance. What does this mean? Let's say the amount you've contributed inside the life insurance with the interest is more than the total premium you paid into the policy. If you take it as a withdrawal, you will need to pay taxes on the growth. Let's say, for example, the total amount you've paid into this policy is $20,000, but it has grown to, let's say, 70,000 cash value, but you needed 50,000. If you withdraw the 50,000, you will need to pay taxes on the extra 30,000 that wasn't part of what you paid in. So that brings us to the second way you can take money from your life insurance, which is borrowing. So when you take a loan from your life insurance policy, you do not bother about paying taxes because obviously you cannot pay tax on a loan. So how does this work? The insurance company actually uses your death benefit as a collateral to give you that loan. Your cash value still continues to sit inside the cash value bucket, making its own interest while you use the money to do whatever it is that you wanted to do with the money. So how much can you really borrow from your life insurance? This determines on how your policy is designed. Sometimes, if your policy is designed to specifically to yield cash value growth, then you fund it differently. So when you fund your money differently, what we call minimum death benefit, maximum cash value, your policy is actually growing you more cash value. That way you can take literally 50, 60, even more than that of what you have in it within the first couple years. However, sometimes your policy is designed for death benefit in mind. This one, we put how much is the minimum amount you can pay in to give you maximum death benefit. In policies like that, you're not typically able to take out cash from it within the first 5 years. This is why design matters. So when you sit with your financial professional or your life insurance broker, explain to them what you're looking to achieve from your policy. That way, they're able to give you the best design. And if you don't have anyone that's helping you out with that, reach out. So one of our professional licensed agents will sit with you and provide the design that fits your need. So when can you borrow from your policy? Again, this depends on how your policy is funded. If you funded your policy as a high cash withdrawal kind of policy, then typically you should be able to take money within the first year, sometimes even within months of starting your policy. But if your policy is designed with death benefit in mind, you may not be able to take money out of that policy within the first few years, maybe even 5, 6 years before you can have access to any money. So it's always advisable to ask your financial professional or request an enforced illustration from your company. That way they'll be able to give you a clear picture of how much and how soon you can take money from your life insurance policy. If you borrow from your policy, do you need to pay back? Well, I'm going to say a loan is still a loan. Yes, you're borrowing from yourself. Yes, the interest is super low. For example, when I bought this home, I wanted to take a loan from the bank, like to build. Okay, they call it construction loan or builder's loan, whatever it's called. They were going to give it to me at 14.5%. I was able to take a loan from my policy at 4%. I could have taken the cash value from my policy, but I wanted to take it as a loan so that the cash value still sits there and making money, because remember, I'm my own bank here, right? So would you rather take a 14.5% loan or a 4% loan? Now the good thing is when I pay back that 4% interest on my policy loan, it goes back into my cash value. So remember, that's how you're rebuilding your bank. So yes, it's a loan and you will need to pay back. Now you can decide to pay it back as a lump sum. Let's say you have a financial windfall, you can pay it back as a lump sum, or you can make a plan to pay it back monthly. You're building back your reserves, so when you need to borrow again, you have it to borrow. And sometimes you don't even need to have finished paying the first loan before you get access to borrow more. Once you have money sitting in that account, you can borrow multiple times, even if you haven't finished paying the first one. So again, what to bear in mind is that this is your bank, you're depleting your own bank. So for you to have it there to borrow again, you want to pay it back over time. That's my thoughts, whether you pay back or you don't pay back. Now, however, there are some policies that would actually do what they call a wash loan, meaning if you borrowed that money and you haven't paid it back, after like a certain period of time, some companies it will be 5 years, some companies will be 7 years, they're going to just wash it. They're going to just take back that money into the policy, and it will look like, okay, you withdrew that money from your policy. Again, ask your company how it works, because that's every single company is different, every single account is different. So how does this beat traditional financing? Obviously, number one, we talked about the fact that it's a lower interest. If you do regular credit card, it's probably 24% APR. This one is probably going to be like 4%, maybe 4.5. But also here, you're being your own bank. So you're building your own wealth. You have more control. You'll decide the terms. So instead of going to pay someone else 24% or 20% or even 14%, why don't you pay yourself back 4% while building your cash value with uninterrupted compound interest? What do you think is better? Paying someone else 20% or 14%, or paying yourself 4%? You choose. So borrowing from your life insurance is not something that's reserved for the wealthy. It's actually for anyone that wants better control of their finances. So if you would like for me to help you design a high cash life insurance policy that allows you early access to cash value, click the link below so that we could find time to help you out with that. Now, do not forget to like, subscribe, share this video, and comment. Maybe there's a point that we covered that you want to throw more light on. Feel free to throw more light so that our community will benefit from your ideas also.